Stop what you're doing right now. Put down whatever you're holding and sit down. Listen to me very carefully. What I'm about to tell you is not a theory. It is not another prediction from a talking head who has never managed real money through a real crisis. This comes from someone who has sat across the table from the most powerful financial institutions in the world, who has bet against governments and won, and who has watched the exact same warning signs appear before every major financial catastrophe of the last 50 years. Right now, those warning signs aren't just appearing, they are screaming. I've been in this business for over 4 decades. I started managing money when interest rates were sky high and America was stuck in stagflation. I've navigated the 1987 crash, the 1994 bond market collapse, the Asian financial crisis, the dot-com bust, the 2008 financial crisis, and every turbulent cycle in between. In all that time, I have never once walked up to my bank and found the doors locked. I have never been told I couldn't withdraw my own money. But here's what keeps me up at night. We are now closer to that moment than we have ever been in modern American history. And most people, especially those in their 50s, 60s, and 70s who have spent decades building savings, are completely unprepared. Let me show you exactly why, using the numbers that don't lie even when politicians do. As of 2026, the United States is carrying over $39 trillion in national debt. That is not a budget problem. That is not a temporary fiscal challenge. That is a structural crisis that has been building for over 2 decades while Washington printed money, cut taxes without cutting spending, and quietly handed the bill to your generation and the ones that follow. What makes this moment uniquely dangerous is the cost of carrying that debt. Right now, the federal government is paying more than $11 billion every single week, just in interest, not paying down principal, not building roads or funding defense, just interest. And we are spending 40% more than we collect in taxes every year, so the debt keeps growing. The Congressional Budget Office projects that net interest payments will total $16.2 trillion over the next decade, rising from roughly $1 trillion this year to more than $2 trillion annually by 2036. Interest is already the 3rd largest item in the federal budget, behind only Social Security and Medicare, and those programs are not safe either. Social Security's trust fund is projected to be depleted by 2032. When that happens, benefits will be cut automatically by about 28%. A typical couple retiring around that time could lose roughly $18,400 a year. That is not fear-mongering, that is math. Now let's bring this back to the banks, because this is what directly threatens your immediate financial safety. In January 2026, the first U.S. bank failure of the year was confirmed, Metropolitan Capital Bank and Trust in Illinois. Regulators called it routine, the media barely covered it. But here's what they won't tell you. The bank didn't fail just because of bad management. It failed because in a high-interest rate environment, banks holding long-duration loans and securities are sitting on massive unrealized losses that are slowly bleeding them dry. The FDIC knows this. They track these losses across the entire system, and they remain enormous, especially at smaller and regional banks. The stress has not gone away. It has simply been papered over. Remember March 2023? Silicon Valley Bank, Signature Bank, and First Republic collapsed within weeks, carrying a combined $549 billion in assets, the worst year for bank failures by asset size since 2000. What happened at SVB is the template. Once word spread about unrealized losses, depositors started pulling money. Social media accelerated it. By Monday morning, the bank was gone. In today's world, you can wire your entire life savings out of a bank in 30 seconds from your phone. When confidence breaks, it doesn't break slowly anymore. It breaks all at once. I'm not saying a massive bank failure is coming tomorrow. I am saying the conditions for bank runs and withdrawal restrictions are more present today than at any time since 2008. Most people think they'll get a clear warning. They won't. There will be no press conference. What actually happens is that banks quietly start delaying large wire transfers, put holds on big cash withdrawals, or close branches early under vague operational excuses, while regulators scramble behind the scenes. By the time most people notice, the window to act has already closed. And then there's the FDIC insurance limit. Still $250,000 per depositor, per institution, per ownership category. That limit hasn't changed since 2010. In a world where inflation has eroded purchasing power for 16 years, that ceiling covers far less than most people realize, especially retirees with decades of savings. During the SVB crisis, uninsured depositors were made whole only because regulators invoked a systemic risk exception. There is no guarantee they will do it again. So what should you do? First, know exactly where your money is and how much is actually FDIC insured. If you have more than $250,000 at any single bank, spread it across multiple institutions and multiple ownership categories. Individual accounts, joint accounts, and retirement accounts are each insured separately up to $250,000. This is basic, non-negotiable financial hygiene. Second, keep some physical cash on hand, enough to cover 3 to 6 months of essential living expenses. I'm not telling you to bury money in the backyard. I'm saying that in a world where digital systems can and do freeze, even a 72-hour disruption can become a serious problem. Don't be the person who has nothing but a debit card when access is temporarily cut off. Third, own something outside the banking system entirely. Gold and silver are not traditional investments. They are financial insurance. They have survived every currency crisis and banking collapse in history. Having 5% to 15% of your net worth in physical gold and silver is a rational hedge against the monetary disorder these debt numbers point toward. Fourth, if you hold a large portion of your retirement savings in long-duration treasury bonds or bond funds, understand the risk. In an environment where the government is spending 40% more than it collects and debt is heading toward 131% of GDP, bond yields will likely keep rising, which means bond prices will fall. The classic 60-40 portfolio has been quietly destroyed in this environment. Fifth, if you're 60 to 65 and counting on Social Security as a major part of your retirement income, plan right now for the very real possibility of a roughly 28% cut in benefits starting in 2032. The math of the trust fund is not fixable without major changes. What we're seeing is not one event. It's a slow, grinding convergence of decades of fiscal irresponsibility and monetary distortion finally reaching the point where the math can no longer be ignored. The people who come through the next few years in good shape won't be the smartest or the best connected. They will be the ones who took the threat seriously early and made quiet, unglamorous adjustments, while everyone else was still saying, everything is fine. Check your FDIC coverage today. Spread your deposits if needed. Keep some physical cash. Seriously consider hard assets like gold as insurance. Rethink heavy bond exposure. And build a retirement plan that does not assume full Social Security benefits in 2032 and beyond. This is not left or right. Both parties contributed to taking the debt from $10 trillion in 2008 to $39 trillion today. You are the one who will live with the consequences if you don't act. I've been in this business a long time. I've been wrong before and I will be wrong again. But the cost of being wrong about the safety of your life savings at retirement age is far too high to ignore. Take this seriously. Share this video with someone you love who needs to hear it. Drop a comment below with your biggest financial safety concern right now. I read everyone. If this made you think differently about how you're positioned, hit like and subscribe. We're going to keep having the honest conversations that others won't. The first day a bank refuses your withdrawal is not the day to start preparing. That day has already passed. The day to prepare is today.